This episode is brought to you by Ocrolus. Better lending starts with better intelligence. A borrower's cash flow only tells half the story, so Ocrolus fills in the rest with behavior signals and industry benchmarking. Visit ocrolus.com to learn more. Hello, and welcome back to the Fintech Takes podcast. Today's episode is about one of my all-time favorite topics, one of those areas in financial services that is fun to talk about and fun to research because it's so freaking hard to solve: small business lending. If you've read the newsletter, if you've listened to the podcast, you know I could not be more interested in understanding why small business lending is uniquely challenging, how it has changed over time as technology has been applied to it. We've seen more fintech competition, and crucially, for a conversation in 2026, how AI might finally unlock some of the challenges that we've been really stuck on in small business lending for decades. The perfect person to have this conversation with is David Snitkoff, today's guest. He is the GM of SMB at Ocrolus, someone I've known for a long time, a fantastic basketball player, by the way, and a really great conversation partner and thinking partner on this very tricky, challenging, and fascinating topic of small business lending. David and I cover a lot of ground, and as you will hear from our conversation, he brings a lot of firsthand experience to this topic. I learned a lot and was frantically taking notes throughout the whole episode, which you may hear. So without further ado, here is my conversation with David Snitkoff. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, well, making his Fintech Takes podcast debut, David, thanks so much for coming on.
All right, thanks, Alex. Great to be here.
It is delightful to have you here. I feel like you and I have probably talked many times over the years about small business lending, one of my favorite topics, probably like in between games on the basketball court, maybe. But this is the first time we're doing it.
It's a great time to talk about credit.
Exactly. Like
you know, basketball credit. Eventually, you do it with a mic and a camera.
Exactly. So we've warmed up and we've done our obligatory stretches, and now we get to the main event. David, I have a theory about small business lending that I want to bounce off you. And you've worked in commercial lending for a while now, so I'm hoping you can just help me workshop this theory. Does that sound like a good place to start?
Sounds great.
Okay. So the basic observation I've had, and I would say I've more worked around small business lending than worked directly in the trenches, but the observation I've had is that commercial lending is just deeply contextual in a way that consumer lending isn't. You know, consumer lending, while we might like to pretend otherwise because we all like to feel like we're sort of, totally unique individuals, from a data science perspective, that's not really true. Consumer lending is very homogeneous. Borrowers act roughly the same. Credit risk decisions really come down to an assessment of reliability and capacity. Consumers go through this very sort of kind of predictable pattern through their life where they hit different life stages and they have, predictably different needs. Commercial lending is very different. And I think for two main reasons. First, companies are not homogeneous. They're all extremely different from each other, depending on their size, their location, what industry they work in. And the second reason is, again, different from consumers. Companies aren't static, right? Again, consumers move through life in this predictable, slow-moving sequence with a few big moments interspersed along the way. We really know what that looks like. The lifespan of a company, I think, is much less linear and predictable, and certainly much faster moving, right? It's fast, it's chaotic, it's unpredictable. And as such, I think the only way to really safely underwrite a commercial loan is by understanding as much of the context surrounding the company as possible. Now, the problem, I think, fundamentally is that understanding context is really expensive, right? You have to have a lot of information about the business that you take in. And, quite frankly, and this is what you can really speak to, it requires a lot of judgment or intelligence or experience, like whatever we want to call sort of the art side, if it's a mixture of art and science, like that art side is very important to understand context, which historically has meant that you have to have human loan officers and underwriters somewhere in the process. And of course, as we know, human loan officers and underwriters are expensive. Now, the interesting thing, if you look at the market and how it sort of segments itself, everything I just described is not a barrier to success in commercial lending for large companies, right? Because the size of those loans and the margin associated with those loans can absorb a lot of costs, right? Commercial lending in that respect is kind of like mortgage on the consumer side, right? Like there's more than enough margin to pay for a pretty meaty process with lots of humans involved and lots of steps along the way. Obviously, small and medium-sized businesses don't have that same margin to play with. And I think that's fundamentally why you see this sort of persistent finding that's been true at least as long as I've worked in financial services, that small businesses continually report that they don't have access to as much credit as they would like. When they apply for credit, they don't get approved for as much as they would like. They don't get approved at rates or terms that they would prefer. So there's this persistent sort of underserving of small and medium-sized businesses. And every time there's a new wave of disruptors who come into the market, they sort of look at that and go, oh, well, I'm sure that's just because banks don't know what they're doing and like we can figure this out. And then they kind of run into these sort of structural challenges that exist in commercial lending, this need for context and the fact that it doesn't scale easily down to the smallest level. And then they sort of have to figure out the same first principles problem and what their solution might be to it. So I guess two questions for you, David. One, what do you think about my theory? And two, how have commercial lenders, at least over the course of your career, and you've worked in this space for a long time, how have they tried to solve for this fundamental, let's call it context margin paradox that I described?
Yeah. So first, I really like the theory and the way that you've synthesized this. And to back up a little bit, lending is very much about decision-making under uncertainty and asymmetry. And the asymmetry, you make a little bit of money on a good loan, you lose a lot of money on a bad loan. And then on the uncertainty side, it's impossible to know all the relevant information about the context, as you said, about the borrower, the environment in which they do business, the macroeconomy, at the time that you make an underwriting decision or other lending decisions. And then you add on to that, there's so many different types of businesses. And these businesses operate in different sub-industries. They can be highly complex, dynamic entities across all these different dimensions you've laid out. So when we talk about that asymmetry and uncertainty, the uncertainty aspect is really magnified in the commercial space. And for me, a few things come to mind there. There's always been, in maybe the history of technology, this tension between personalization and scale. So historically, if you want to do something that's quite bespoke, you can do that, as you were saying, for the larger commercial loans. And if you're doing, multi-million-dollar loans or credit facilities to larger businesses, then it makes sense to have a lot of bankers and loan officers work on that, and for them to be, relatively highly paid expert kind of people. And then if you're doing mass market $20,000 line credit cards, that's also quite easy because now you depersonalize, you mass market the thing, and you do it at scale. And now there's science to doing all that well, but you hope that it all plays out in the numbers, but you have to standardize. Small businesses get caught in the middle, and the fundamental heterogeneity of small businesses makes that really difficult. And then the same thing, lenders are always navigating. So there's that tension. They're also navigating the friction between asking an applicant for more data, adding more steps to an underwriting process, again, to better understand the context, and providing a good customer experience, because any individual lender is not the only lender that a customer could talk to. So yes, if they could get all the data in the world, they would, but any customer who's good and has options will say, no, I'm not going to give you 100 months of my bank data or sit through an in-person interview. I'm going to go to another lender, and you might actually negatively select the worst customers who are more desperate for financing. So this context, bringing context from the larger commercial space into the small business space, is very expensive and time consuming. And it's also rare in the sense that you're not going to find the same industry specific expertise all in the same person. So the person who really knows how to underwrite, a dentist is not the person who really knows how to underwrite an ice cream shop or a small manufacturer. And so having this many people is not really doable, all but for the largest institutions. Now, the question is, are we entering an age where AI lets you overcome some of these context barriers that previously existed? And, then to your second question, what have I seen over the course of the last, 15, 20 years? I think regardless of the time that's passed in terms of innovation and technology, the lending equation, the fundamental lending business model is unchanged. Every lender likes to think they're different, and they're different, but fundamentally, you make money on interest and fees, you lose money on credit losses and fraud losses, and you spend money on operational expense, cost of acquisition, and cost of capital. Yep. And so I think we've seen within that model 3 different categories of the approach to the context that you laid out, and we may be in the early stages of a 4th. One is just do what you would call traditional underwriting, but cost engineer it and cost engineer the process to scale it. So, still have manual underwriting, still have very heavy documentation, but, cost engineer it either with technology or outsourcing or whatever it is.
Sure.
You've also seen some small business lenders adopt almost a consumer-like underwriting model. Yep. Where they're using, largely consumer data sources, largely consumer-like machine learning approaches to predictive analysis, and then say, what, do I either, have high enough rates to make the margin work, or just somehow make it up in scale, which is very difficult. There's a third category of lenders, and these are the more recent ones, let's say like most of Fintech for the past 15 years, who have said, let's use automation and machine learning to cost engineer the process, but in a good way that actually provides a good customer experience, and then use sophisticated analysis, cash flow underwriting, targeted marketing, dynamic customer management. That's worked out well, but I don't think it's the absolute frontier of personalized small business credit for each of these types of businesses. I think we're now just starting to enter this age where we have AI agents that can eat a lot of context, and then you can do a degree of personalization and personalized analysis that was previously only possible if you had highly paid humans who had built up a lot of context and expertise.
Yeah, that explanation makes a ton of sense, and I'm glad you kind of walked through the history and the way in which the market has sort of changed over time, because you do see these waves of disruption, right? Like small business is such an obvious target. There's a ton of small businesses. It also, and I think this bears, stating plainly, like small businesses is a very like noble segment of the market to go after, right? Like there are certain parts of the market where it's like a very tempting target, because not only can you go make money and build a great business, but you can also go home at the end of the day and go like, I contributed to the, foundation of economic success in America, which is powered by small businesses. Like it's a business that I think people want to try to make as successful as possible. And, you're right. Like there are different ways to sort of get around the scale problem. To use one example from like an earlier era of fintech, like I remember when Square was first getting started with some of this stuff, and like, Square, like they started doing small business lending, but it was almost more like micro merchant, sole prop small business lending. Like it was people with Square readers at a farmer's market stand on the weekends, right? And to your point, there is a size of business where the loan amounts are very small. You can sort of contain it within an existing environment. And Square was very smart about sort of putting lending in the context of the payment processing that it was already doing. So it's sort of like scoped the problem to a particular size that it could sort of de-risk. And then, of course, like, for small businesses that are that small, that's a business where it really is a reflection of the individual and the consumer. And so you can use consumer credit data. You can apply a lot of the things we do on the consumer side to the smallest small business owners. And, roughly speaking, it works fairly well. And we've seen some success in that area. Another one that you described is, okay, if we're a like a Cabbage or an On Deck or a Blue Vine or sort of that generation of sort of fintech lenders focused on SMBs, it was cost engineering, but with a sort of tech first mindset, right? Can we reduce the amount of paper documentation and get more of this data digitally? I remember talking to someone who was like, you wouldn't believe how much money we saved when we transitioned from, going to do in-person site visits when we were loaning money to a laundromat or whatever, to just having a human go on Google Street View and just make sure it looks like a laundromat and we know it's not fraud and we feel reasonably confident in that. And so there was, I think, a lot of like fat on the bone that you could trim away.
Yeah.
But I think the flip side, and something that you mentioned, and I want to just sort of double click on and get your take on real quick, is this all sort of runs up against the psychology of small business owners, which I do think is important to also talk about, right?
Yeah, very
something
much.
Something I didn't mention before, but I think is very true, is that another difference between consumer lending and small business lending is who you're lending to. And small business owners are a quirky bunch, right? They don't really care about, nor do they want to spend any more time than they have to on the back office side of their business, right? Like they got into being a small business owner because they like construction, or they like making pizza, or they like installing septic systems, or whatever the thing is that they do. And all the back office stuff, including all the financial services components of it, is not really their specialty. They're not trained in it. They are not particularly sophisticated consumers of financial services, at least until you get up into the much larger size businesses where there's a little more specialization. And the other component that they have that I think makes them a little bit different than consumers is, and I've used the analogy of like being a new parent with a newborn at home. Like you're just not a very rational decision maker, right? Like it's all about speed and stress and fundamentally like keeping this thing that you have this irrational fondness for alive at all costs, right? And so
and look, you could even argue that it's rational, but with regard to different dimensions. Like you may not be prioritizing APR, you're prioritizing speed, survival, convenience, personal comfort.
Exactly. Like objectively, you might not be making the best financial decision, but as you say, you're optimizing for a different set of outcomes, right? I remember when my wife and I brought home our first baby, and like they just let you leave the hospital with this is insane. I can't believe we're doing this. And that first night, I think we bought like $800 worth of stuff on Amazon that we realized we needed. And like I was not making rational purchase decisions at 3 a.m, exhausted and scared out of my mind. It's somewhat analogous to like what it's like being a small business owner. And to the point you made earlier, like they really prioritize speed. And one of the things that's so funny about small business owners is in the aftermath, they will reflect back on like the decision they made to take this loan versus this loan or whatever. And they might be kind of bummed about the price they got or the terms or the service or other things like, oh, I wish I had like worked with a community bank or a credit union. Maybe I would have gotten better on those dimensions. But that's not what they were optimizing for in the moment they made the decision. They were optimizing for speed. So I want to, David, maybe deconstruct a little bit like what small business owners over the last, let's say 15 to 20 years have sort of maybe had to give up or sacrifice. Because I think that what fintech companies have done over the last 20 years is really optimized for speed and convenience. And this relates to digital and a lot of those sort of innovations that you were describing. But there is a trade-off that small business owners have had to make in embracing that speed and convenience. Can you talk a little bit about that?
Yeah, and so there's a whole lot there. I think one, as you said, there is somewhat of a nobility in small business lending, and that we all want to help small businesses. And I always say this to the team, at Ocrolus and other places too. It's like, why are we here? Well, credit is kind of this magical technology. It's a technology that a capitalist society uses to express its confidence in the future. And it lets us make commitments today based on this optimistic projection of what's to come. And consumers, businesses, even governments use credit to grow. And if we can do that in an accessible, transparent, fair, and efficient way, we're going to have a higher level of economic growth in society. And we, want to empower all these, as you said, very quirky niche small business owners, because that's what makes a community work. It's like, you mentioned having kids is one of these realizations. Owning a home is one of these realizations where it's like, I didn't realize that, you need to have a B guy and a well guy and a septic guy. And like, there's a lot of guys, and each one of these people is a business owner.
I've got most of those guys now, by the way, David, if you ever need a guy. I now, having done home ownership long enough, I have a WASP guy. I have a well guy. I've got them all now.
So, and each of these people has like a very unique small business with all their tools. And it's funny, like you mentioned Square. If you're in Square, we work with Square, of course, and if you are lending to a business who uses Square as their payment processor, and you're lending in a quite constrained way, you can do that really well, almost with a consumer-like underwriting model, and then actually, scale it in a different way when you want to go beyond into different share of wallet types of customers and have larger loan products. And so, I think what if small business owners had to adjust to or give up or compromise with, I do think there's this view of, let's say, old style community banking and to almost straw man it, where it's like, you watch some old movies or old TV shows, and people have this idea that there was like a community bank in your town, and you went in there and they knew you and the banker knew you, and it was very personal and they took care of your financial needs. That maybe worked in a very ideal case. But if you weren't the right kind of business, you didn't know them, you weren't in the in crowd, and you weren't of the right, group or country club or whatever else that looked to that banker like the person who deserved credit, or you didn't have history, you basically had no choices. So I would very much, of course, take today's system over that one, where borrowers have choice. They can shop around and they can say, do I want to go to a bank, a credit union, a large financial institution, a non-bank lender? Of course, many non-bank lenders now are either building banks or buying banks and integrating that into their strategy, and including many of the companies that you were mentioning there. So, but I think that the speed is a really big thing, and we actually do with our partner On Deck, we do a survey of this every quarter, where we survey a bunch of small business owners, and then we actually look at a lot of the quantitative data that's running through our systems, and we ask them, why, did you go to a bank first for credit, or did you go to a non-bank lender? Why did you do that? What were your top priorities in applying for credit? What's your use of funds? Why are you applying? What did you try first before you applied for credit? Did you max out your credit cards? Did you delay payments to friends and family? And over time, we've seen, the number of people going directly to non-bank lenders, or you call innovative lenders, not traditional banks, going up. And many of the reasons that they state have to do with speed, convenience, and, as you said, just a desire to get it done.
Yep.
A small business owner is a busy person. They're probably, a passionate person about whatever they do. And, you talked a little bit about documentation and data and making data accessible. Like, most people would not believe the volume of documents that are still involved in small business lending. And just to put some numbers on this, we right now, Ocrolus, we process, we will process today 1.25 million pages of PDFs.
Wow.
And that's in addition to all the digital data we process and everything like that. But in small business lending, there's a lot more PDFs than most people outside like the guts of the industry would think. And a lot of that is due to the acquisition channel dynamics. So in business lending, very often applications are coming through brokers. And so businesses will go to brokers will collect bank statements, and then they have some routing logic, and they'll send those around to the lenders or funders, who will, usually wrap them through us. We'll do cash flow analysis, and then they'll make an underwriting decision. It's also because while there's, very good digital aggregators, and we work with Plaid, we work with others in the space, the coverage of commercial bank accounts among many of these digital aggregators lags the coverage of consumer bank accounts. And then the other psychology thing for business owners is that sometimes, I think part of this is because some of the small business lending brands are not as well recognized household brands. Sure. They don't necessarily want to connect digitally until they know that they're getting approved. So, we see this all the time. Someone will submit documents, get initially underwritten with documents, and then be totally good with connecting digitally right before they get funded. And then the lender can maintain an ongoing connection and manage their customer and everything like that. So it's a somewhat more nuanced process.
This episode is brought to you by Ocrolus. Every small business runs on its own financial rhythm. Revenue patterns and operating cycles look completely different across industries, and financial data alone doesn't capture that context. Ocrolus turns financial data into decision intelligence, pairing AI-powered cash flow analytics with borrower behavior signals and industry benchmarking. Underwriting moves faster, and credit decisions get more consistent. Visit ocrolus.com to learn more. That's fascinating. Yeah, I mean, I did want to double click on data because I think that fundamentally that is kind of the foundation of the problem, right? And, as you said, coverage on the consumer credit bureau side is pretty robust, right? I mean, like I probably complain and criticize the credit bureaus on the consumer side more than anybody. Like it's kind of one of my hobbies. But for all of that said, they work pretty well, and they have really strong coverage and good data quality, and like plenty of things to nitpick. But it works pretty well. And again, it's this homogeneous population that has great coverage. That just does not exist on the small business side, right? And, you can find bureaus that have some coverage of some data, but like the reality from a small business perspective, and this goes back to kind of the inherent differences between consumers and small businesses, is small businesses, like, it's hard to really like overstate this. Like, consumers are born and then they hopefully live a nice long life and nothing really changes that much. Small businesses are born. Small businesses pivot 19 times. They change their name. They move into different industries, different locations. They die all the time. Like, small business is just a really dynamic area compared to consumer. And so it's not even really a critique so much of the commercial credit bureaus because they do the best that they can, but it's just a really hard problem to wrangle from a data perspective. And then, of course, as you mentioned, there's a ton of paper documentation, bank statements, PDFs, financial statements. There's just, tax records. There's all kinds of stuff that's still transmitted via like, PDFs or like faxes. Like, we're still faxing things in some corners of commercial lending, which is wild.
Probably more in mortgage than commercial lending, but it happens. It may happen.
Yeah, I mean, it occasionally still happens. Like it's very out of step with how kind of modern consumer lending that we might think of works. I want to talk a little bit about where things are starting to change on the data front. And obviously, I guess a couple things I would flag, and then you correct me where I'm getting this wrong. As you said, like system-to-system integrations are now, I think, more common than they were. And so obviously the same sort of open banking, consumer permission data revolution that happened on the consumer side has also hit commercial. You can connect your bank account, but there's also other sources of data too that I think is kind of interesting, right? As we talked about before with Square knows a lot about you as a business because they process your payments. You might even manage like marketing or inventory or other things through Square's kind of commerce enablement platforms. And those platforms also exist at Shopify and any number of other places where you might operate your small business. A lot of small businesses actually use multiple platforms for sales and marketing and inventory management. So it might be spread out across a bunch of those. You can, in some cases, permission access to that data. Same thing applies from like an accounting perspective, right? And what's interesting to me is that I think there's like a trade-off, it seems, between the ease of accessing that data, or as the consumer permissioning that data, or the customer, I should say, permissioning that data, or as you said, the small business owner being willing to give access to that data at different steps in the process, versus what I would think of as like the fidelity of that data. And one of the things that someone told me a while ago that I've always remembered is they're like, look, picking on accounting data for an example, like accounting data is great. It's relatively easy to connect to your accounting system and like pull that in. But this is the way the small business keeps track of its own information. It's not necessarily a perfectly accurate reflection of the actual financial status of the business. And in fact, because small business owners are notoriously not accountants and not necessarily good at the back office bookkeeping parts of their business, you don't necessarily want to totally always believe the accounting data, even if they're very happy to permission it and give you access to it. So can you talk us through like kind of the frontier of digital data within the small business landscape and kind of what that looks like?
Yeah, so accounting data is a really interesting place to start because I think people do have this assumption that accounting data is a reliable source of data. And if people are doing their books in QuickBooks or Xero or whatever, that you can permission that data. And, if it's high quality, it is valuable. It is less likely to be high quality the smaller the business is, because you probably started a business because you were good at baking, or you loved selling books in a bookstore, or you were really good at killing bees at your house or my house, but not because you were so great at bookkeeping. And so some of that data,
the only small businesses that are great at that are bookkeepers, right? Like if the small business is a one-person accounting shop, then you're good. Yeah,
fantastic. Just give us your accounting statements. For larger businesses, larger line sizes, maybe a business has a greater degree of financial and accounting rigor, and so you can count on that. And of course, we see our customers who get in to larger loans and lines requesting financial statements, accounting data connections, all that kind of stuff, and they'll do a broader underwrite. What we generally find across small businesses is where cash flow underwriting really shines, and that bank transaction data is just the best way to truly understand the nuanced operating dynamics and financial health of a small business. Now, It's difficult, of course, because there's 8,000 something banks and credit unions in the US. And so you get this bank data in many different formats and qualities. Sometimes it's through documents, sometimes it's through digital connections. The accuracy there is really, really important because the analytics really matter. Now, the interesting thing is you still need a ton of contextual knowledge to properly understand what this bank data represents. Does a bank transaction represent revenue, expense, proceeds from a lender, payments to a lender? You would define those things differently for different industries. But I think, the frontier now, and this is partly standard practice for the most innovative lenders today that we see, but it's also part of the frontier for how people are pushing it. Can you get as much nuance as possible out of this banking data, understand the transactions, their categories, their counterparties, the patterns, the periodicity, and use that to basically map to all the things that you would want to understand from traditional financial analysis. And then where I think the context helps, imagine you were a manual underwriter looking at that. You would spend a long time then researching everything else about the business, everything you can find out about them, the economy in which they do business, how they compare with their peers. Now, AI agents make that faster, or at least more reliably scalable.
Yeah, that makes sense. I mean, maybe double clicking on that, one of the things that I'm curious about is more on the analytics front, right? So stepping one layer up from the data. I mean, you've talked about the fact that like specialization is really important to understanding context, right? And the way I would sort of describe community banking, doing small business lending, and kind of that like old-fashioned It's a Wonderful Life sort of vision of how it used to work, is that George Bailey didn't necessarily have a great deal of expertise in any one specific industry or vertical. Like he didn't know that much about baking. He didn't know that much about car repair. Like there's a whole bunch of things that like he only had a cursory knowledge of. But that was sort of overpowered or rendered somewhat unnecessary by more of like the character community side of it. So it's like, as a community bank, I might only ever underwrite like 2 dentists' office for loans.
Yeah.
But I know enough about those individuals. I know enough about how they interact with the community, how many dentists' office this community can support. Like I sort of substitute my local knowledge in for my lack of knowledge about any one particular vertical. And I roughly make up the difference on being able to make a good-ish loan at relatively small sizes. As we move into the future where, everything's kind of gotten flattened out. And if I'm a small business owner, as you said, I have a million different places I can look. And, it might not be the community bank that I'm walking into, especially if I have to take a day off work to go sit down and do an interview with a loan officer, it would seem to me like one of the things that's likely to happen is that small business owners will start to sort themselves a little more by industry or vertical and try to seek out lenders that have a little bit more of that specialization. Because, and I think this is probably more and more true as you get like bigger. Right? We've focused more on like the small business side, but like I think there's a huge gap in the market with like medium-sized businesses that just don't fit neatly into any of these buckets. We're like, we're fairly big. We need to make a big capital investment in whatever, new trucks or new ovens or hiring these people or doing whatever. And in a lot of cases, like that is like, it's almost more like VC investing where it's like, we know that we can take our business to a whole new level if we do this, but we need capital to do that. Well, okay. When I go explain that to someone, they might need to have a pretty good knowledge of like my industry and what the trajectory of success looks like for a business in my industry versus another. So I'm curious, as it relates to like analytics and processing the data, and even things like, I know you're a student of like the growth of vertical SaaS platforms and kind of more specialization. How do you see that playing out? Because it does feel like all things being equal, there is a benefit from a small business or a medium-sized business's perspective in working with a lender who understands your business and your vertical and can underwrite to that knowledge more specifically.
Yeah, totally. And to just illustrate that, I remember back in the early growth days of peer-to-peer lending, which then became marketplace lending. And, I'd of course, in my business back then, we would meet a ton of new lenders. And sometimes when people said, hey, we're starting a new small business lender, and I would say, what kind of small business lender? They'd say, well, all of them, every business. I'd say, I don't know. That makes me a little bit worried. So first I'll talk about the analytics and how you specialize that and maybe get into vertical SaaS. Even when we're talking about cash flow data that we were just talking about, fundamentally, what do you want to understand with the business? The revenue, the expenses, the balances, counterparties, debt capacity, payroll, negative events like overdrafts. A ton of context is required to evaluate that. And the context is very often industry dependent. So to give an example, imagine, you're a small business, you have transactions in your bank data, and you have a credit from an insurance company. For most businesses, that's not revenue, it's just a claim payment. However, if you're a dentist or an auto body shop, that's how you make your revenue. So now, if you're a company like us who does these analytics, or if you're a lender using this, you need to treat all these industries a little bit differently. So even the analytical layer has to become specialized. Then the question is, once you have those data points, how do you put it in context with a business's operating model? So of course, the operating model of a retailer or a manufacturer or a service business is very different. And I remember thinking about this a lot when I was at Cabbage, where it's like, if you have an ice cream shop in Connecticut that makes $50,000 a month in revenue, I have unfortunately never run an ice cream shop, and I don't know whether that's good or bad. Maybe that's a lot of money, maybe that's a little bit of money. Not all revenue is created equal, and different types of businesses have different gross margins and cost structures. But we can say, hey, if we've seen 30,000 ice cream shops over the past few years, we can contextualize that number and draw a distribution and say, you know what, this one is in the 63rd percentile of monthly revenue and the 41st percentile of monthly payroll relative to its peers in the same industry and geography. And then, then the next level is, okay, can you put that data in context with a lender's particular customer segment and product and portfolio? So I think the credit and fraud risk of an individual small business doesn't exist in a vacuum. Like, it's not an isolated property of that business. A lot of it is dependent on the product, the environment, the lender, how the lender runs its business. And so lenders really gain from fine-tuning a lot of these cash flow analytics and other data points to make them most effective for their own businesses. And we actually end up doing a lot of what you might call forward deployed data science in that area. So vertical SaaS you asked about, and I think that's a really interesting trend where it's like, the shape of a business's context comes so much from the industry and operating model in which a business operates. So it makes a lot of sense to develop vertical software that can form like the data, accounting, CRM workflow engine for that type of business. And then if you're doing that and you have all the data, you have the information running through you, you are theoretically in a very good position to provide financial products for that type of business. And they can be, powered by this shared vertical specific context. And I still think, there's a lot of juice behind this trend. And I think it's a really interesting one, a really good one. I think we're still very early in that cycle. And so a bull case for this is, well, because of AI, now, number one, it makes sense to develop vertical operating systems for even more niche industry categories where there may not have been an ROI before, but now, if it takes less to get started, less to build that and bring it to market, it makes more sense to develop these niche platforms. And that really lends itself to offering highly tailored and useful financial products. The bear case, I think, is that maybe AI actually leads small businesses to want to change their vendor stack more frequently. And then maybe they actually don't want to tie their financial services provider too closely to their operating software. And I think it's not going to be one or the other. It's going to be a little bit of both, but we're quite early in this trend.
Yeah, it's a great point. I mean, I think a lot about like the transition from like Square, which does lots of different verticals, including restaurants, to Toast, which just specializes in restaurants. And how much better can we serve restaurants than a Square or other providers that sort of work across multiple industries? And how much do restaurant owners respond to that like specialization of like, wow, this software feels like it was built just for me? But to your point of like going even further down, then you have someone like Slice that just specializes in pizza restaurants, and they will go all the way to the point of like, helping you figure out how to source boxes with your logo on it for like sending out the pizzas. Like it can get down to a pretty like niche level. And it is fascinating because another part of the sort of bear bull case for vertical SaaS to me is how like scalable are these different businesses from a funding perspective, right? Like if VCs have to back these businesses, there's only certain so far down that kind of niche path that you're going to want to go before you're like, this isn't really worth our time to invest in. But to your point, if we live in a world of AI and the cost of developing software continues to drop down and get lower and lower, well, you might see like a small business owner who spends 20 years doing pipe fitting or whatever it is that they do and just go, you know what? I'm kind of tired of this. I think I'm going to use AI and my knowledge of being a pipe fitter to create the perfect niche vertical software platform for pipe fitters, and like just like
and it's
these
brilliant.
tiny
It's
little,
amazing.
Yeah. And it's like, and someday private equity will buy me and will roll me up into some large thing. But like, I can this is like the second half of my career is like building this thing with the help of AI, even though I don't know how to code. And so I do think that there is a lot of interesting room to run there. And that, of course, brings us to sort of the AI conversation, which we've kind of nibbled around the edges of, but I want to have in a more substantial way. So you've talked about the fact that obviously, like I think you and I both agree, small business lending, commercial lending, highly, highly context dependent for all the reasons we've described. Even something like, to use your ice cream example, seasonality matters a ton in some businesses, right? And so it's like, oh my God, this business only made $10,000 in revenue last month. Well, okay, it's an ice cream store in Maine. So the fact that they made $10,000 in January is actually really, really good and a sign that the community loves them and they're doing extraordinarily well. Like you have to be able to put these things in context. As you said, AI loves to just eat context. Like that's what AI does. Like it loves to get as much context. Anyone who's messed around with any AI tool for any amount of time knows it just like asks you questions and it wants more information. Like it just wants to like learn more about the context around the task or the question that you're asking it. And I think maybe to add to that a little bit, because we haven't talked a ton about this, but revisiting the data conversation, a lot of what we sort of have to make judgment calls around in commercial lending is difficult to structure, right? It's unstructured data to varying degrees, right? And I mean, I know you guys have dealt with this at Ocrolus for a long time, because even going back to like the sort of early like OCR type days, it's hard to fit things into a strict machine learning model,
Yeah.
breaks as soon as one thing is different by like 10 degrees, right? AI doesn't have that problem. Like it's delighted to evaluate loosely structured data, differently structured data, completely unstructured data. And so I'm curious, maybe starting on that data level, how you see AI and LLMs and agentic AI playing a role. And then I'd like to talk a little more about like how it may change the relationship between lenders and small business owners. But let's start on more of the data analytics level.
So, and some of this question is why it's such an exciting time in the analytics world for small business. And if you think about, like you mentioned the standardized data and the square rectangle, if you will, where it's like, what types of data problems are responsive to the past few decades of traditional statistics and machine learning, even at large scale, still, deterministic machine learning. You need large data sets of very standardized data with high reliability, high fill rate, consistent distributions, good stability over time, all that kind of stuff. And if you have that, you can build like highly predictive models and a lot of personalization and do that for credit risk, for fraud, for marketing, for customer management, cross-sell, all the decisions that you make in a lending business. And there are companies like, I worked at American Express. We did a lot of that there. Capital One is famous for doing a lot of this, and they've been really successful. That data exists very well in the, consumer credit CRA kind of environment. In small business, it's just more of a mess. It's more of the real world. It's more fragmented. And so the type of data, the structure of data, the fragmentation of the data is not always responsive to the same traditional machine learning models. And so this is where AI gets really interesting, because if you tune the models the right way, they are particularly good at understanding the nuance, having unstructured data, identifying the gaps, filling in the gaps with context that makes sense. And I think like in a way that the technologies of, let's say, 10, 15 years ago unlocked the power of big data. Remember when everyone was talking about big data? In a sense, AI that has been pre-trained on massive data now unlocks the power of small data. And we've actually seen a lot of success with this in our own operation. Even bringing it out of the credit decision for just a second, like we use a variety of different AI models in our work at Ocrolus, and we will use models from the foundation labs we'll use OpenAI and Anthropic and Gemini. We will use smaller off-the-shelf models. We'll use models that we built in-house, but we'll also sometimes use open source, open weight models, and then prune all the other capabilities from them. So they don't need to be good at writing poetry or producing a podcast or doing video editing or whatever. They just need to like read a pay stub really accurately and calculate, the Freddie Mac income calculation on a mortgage. And that's all they need to do. You take all their intelligence, fine tune it on our data, make it work for that. And then it's a lot more efficient and speedy and cost effective. And so I think AI unlocks a lot of the power of this small data, and AI can really help resolve this conflict we were talking about earlier of the tension between personalization and scale. And where this may go is like, for a long time, and this is still true to a certain extent, where it's like, yes, a lot of the data and analytical techniques from the consumer credit world will go up market and have like more sophisticated statistical analysis and automation and good customer experience go up market. And I think that's also true. But at the same time, a lot of the traditional underwriting techniques that we're talking about may actually come down market, except instead of having, a carbon-based underwriter, you have a silicon-based underwriter, which is in theory more, observable and reliable and cost-effectively scalable, and gets you out of that ultimate black box of the human mind.
Yeah, I mean, that to me seems like the ultimate sort of end game for a lot of this. And to your point about specialization, like, we tend to think of AI monolithically, but I think that the value of it really is, how can you as a business, as a lender, put yourself in a position where you can get enough experience to train like the best dentist office underwriter, right?
Yep.
And not even like underwriter for all dentist office lending needs for capital improvement loans, for commercial real estate. Like, I mean, you can get very specialized. And, because of, as you described very well, the distinction between like pre-training on very large data sets. So you have this like kind of generalizable, flexible intelligence, and then layering on top of that a lot of specialization. One thing that I've observed that I think is really fascinating is, these generalizable models, they don't need that much reinforcement learning. They don't need that many at-bats before they get pretty good at doing this because they have such strong general intelligence capabilities underlying them. The last thing I want to ask you about, David, is a little bit more science fiction because we're kind of skating into the future here a bit. But give me one sort of thought or prediction maybe on how you might see AI agents and the sort of agentic capabilities that we're starting to get change the way that like small business lending works on a more fundamental basis. Because you mentioned something before about like small business owners, like brokers are still a huge thing in lots of different areas in lending, certainly in small business where it's like, hey, I need a loan. I have like small business owner, I have a guy and I call the guy and the guy routes me to a lender and helps me find something. Brokers famously are a place where a lot of bad incentives can creep in. And it would seem like an AI agent may be the broker of the future. Like, give me a thought on how the relationship between small business lenders and small business owners may change thanks to agentic AI.
Yeah, and the science fiction piece of this is fun. And even just talking about brokers for a second, there's such a range of brokers. There's very sophisticated customer focused brokers who are really matching people with the right financial product. There's also a very long tail of people out there who are kind of smaller shops and they're doing all kinds of different things. I think that the acquisition channels for small business lenders will probably diversify over time. It's just like, in so many markets, you never get away from, let's say, brokers, but do they become a smaller proportion of many lenders' acquisition over time? Maybe that's true. I do think AI agents have the ability, as you said, to change some of the relationship between business owners and their lenders. Because again, if you think about what a business owner really cares about, almost every single business needs capital to thrive, to grow, to manage their working capital, to run their business. But every business is different. They have unique context. They operate in a different environment. The business owner has their own priorities. They have different financial background. They have different financial sophistication. And then also, so there's this great mix and heterogeneity of like timing, suitability, what's the right product, what's the right size, who are your counterparties, what's the term, how flexible does it need to be? And today we still, with all the sophistication we have in what you would call like plain old-fashioned automation technology and customer experience, we still live in a pretty linear world. Someone realizes they need to apply for credit, or maybe they get a marketing campaign, then they decide to apply, they get approved or declined, then they are serviced and they go forward. Maybe they get renewed over time, maybe they expand. But it's still a pretty linear world. You could imagine a world in the future where if you have AI agents, I think the business owners will have AI agents that are operating on their behalf to say, if you were a larger, more sophisticated business and you had someone who worked for you, who had all this financial expertise, but also the context in your business, could they help you optimize your financial life as a small business and seek the right form of credit at the right time and the right terms and really time and size that appropriately? And I think you'll also, and this is already starting to happen, you'll have AI agents working for the small business lenders at all these different phases of the customer life cycle, helping you figure out, of everyone you could prospect, who should you prospect? Of all the customers in your funnel, how should you triage this funnel and treat these customers in the right way and personalize the approach? Of everyone in your underwriting process, how can you underwrite them with the right context so you can truly make the right decision for that business? And by the way, do so in a compliant way. We haven't talked about compliance here, but again, when you're talking about personalization, now you get away from some standardization, which is usually the opposite of compliance. So you need a whole different framework there. And you imagine also having AI agents for the lenders working on, fraud risk, customer management, servicing, renewals, collections, all those kind of things. So I think you will have a panoply of agents working with each other. And again, we are super, super early in this cycle. And it'll be very interesting to see how this plays out over the next few years.
It really will. I'm deeply curious about it. I think you're right in the sense that we are just so early on a lot of this. And it seems obvious, even being early, that small business, it's just going to be such a great place for these new technologies to play in because, as we've been talking about, it's complex, it's context dependent. Like this is the most persistently thorny problem in, I think, almost all of financial services. And it has been over the course of my entire career. I know you feel the same. So I'm very excited to see what changes here. David, we'll have to have you come back on as AI and everything progresses. But for the moment, we'll leave it here. Thank you so much for coming on the podcast.
Yeah, thank you, Alex.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.